all sorts of forums and books and magazines, they come across this concept of buying a block of units. And a lot of people say, look, this is the bee's knees, the panacea, the passive income goal. This is where real money is made. In this episode, I'll talk about the pros of buying blocks of units and also the negatives. And at the end of the episode, I'll give you my conclusion as to whether you should actually adopt this strategy because it could be a fast track to your passive income goals or not. Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. Blocks of units are basically when you have like 3, 4, 5, 6, 7, up to however many on a single title. You would have driven past it. It's like, typically they're like brick and there's like maybe 2 or 3 stories high and they may be like 30, 40 years old. Like that's the kind of ones I'm talking about, sort of 4 units, like double story, 2 buildings next to each other, or just like one building with 4 units, 2 at the bottom, 2 at the top, or 6 or 8 or 10 or 12 or 18, however many units. I'm not talking about high-rise towers or apartment blocks that are like, 1,000 in there or 500 in there or 100 in there. I'm not talking about that. I'm talking your everyday run-of-the-mill block of units that can range from anywhere from like 500,000 to like, let's say, 2 million or 3 million or something like that. That's kind of where I'm sticking to these pros and cons. Let's start with the first positive. So the first positive is that the yield is higher than normal houses. So a lot of people are like, why established houses, new houses, why should I buy something like that when I can just buy a unit block and get multiple streams of income and really only have one property to worry about? The yield is so much higher, and that's true, like on the face of it, and that's one of the positives. Whereas a average Sydney, Melbourne property will be yielding 3, maybe 4%, Brisbane maybe 4, 4.5, 5%. Other capital cities like Adelaide and Perth, maybe like 5 to 6%. Regional Australia, good houses, established houses, 5 to 7%, maybe touching 8%. Blocks of units can yield higher than that. In fact, the average block of unit does not yield under 6%. It's well over 6%. So that's one reason why you should consider buying a block of units, because, hey, we're all doing this ultimately to retire, right? Retire early. And so why not go for something that's got higher cash flow? But more to come on that. The second positive is that if these units, like let's say there's 4 units and they're not yet strata titled, they're all on one title, you can spend like as little as even like $6,000, $10,000, $15,000, $20,000 strata titling them, separating them from one another from an ownership perspective in the eyes of the council in terms of titling. And what that means is that all of a sudden each of their values rise. So you might buy a block of units, I'm just using round numbers here, for let's say $1 million, and there's 4 of them. So each of them, and they're not strata titled, each of them is $250,000. You spend, let's call it 10, 20, maybe $30,000 on strata titling them, depending on where you're buying in Australia. And then all of a sudden, like these are real numbers, but example, but these are like, very feasible. That $250,000 block, or that $250,000 unit, I should say, goes up to 300 or 350, maybe even 400, depending on what the quality and where you buy is, because now it has its own individual ownership. So that all of a sudden means that let's just say it goes up to 400, like an extreme example. Now you got 4 of them at 400, that's $1.6 million. You've just made, I'm just talking gross here, you've just made $600,000 by spending what, $10, $20, $30,000 with a bunch of paperwork with council strata titling them. So that's another positive of buying unit blocks. There's an immense opportunity to add value immediately through really very little work. The fourth positive of unit blocks is that tenants are really easy to find. Of course, right now, 2023 is a rental crisis. I think this rental crisis will go on for many, many years. So it's not hard to find a tenant, regardless almost of the type of property you buy. But in even bad times, tenants are easy to find for unit blocks because let's be honest, like it's so cheap, because they're only renting that one unit. It's not like there's land for them to pay rent on and like an alfresco patio area, etc. It's just a very simple, cut and dry, basically four walls. It's a unit, and so rents are normally well under $500. Now, of course, this is a generalization, and there's more expensive ones, etc. But the point is that they're cheaper than renting out a whole house. So there's always so much demand for them because it's always affordable. So that's another third positive, that there's very little vacancy, and you can always find tenants really easily. The fourth positive is that there's less land tax for multiple streams of income. Like, let's say you were to go out and buy 4 houses, and for this argument, I'm just saying they're all in the same state. All of a sudden, you'd start to pay land tax. Like, let's say you've bought 4 houses at $400,000 each. That's going to tip you over into the land tax threshold to the state that you've bought in, regardless of which state or territory in Australia. So we're paying land tax on, basically all those houses after that threshold. But with a block of units, even though you have 4 rentals, 4 units, the council is only charging you land tax if you indeed cross that threshold of land holdings on that one property, okay? Even though there's 4 units, it's just one property. So, that means that you're getting multiple streams of income, but you're basically getting a huge economies of scale from a land tax perspective. So those of you who have done unit blocks, you'll know what I mean. Like, this is a very subtle point, and maybe new investors won't really fully appreciate land tax, but it's really important to minimize that if you can. Those are the 4 positives of unit block ownership. Let's go to the negatives, because there's always negatives to anything in life. All right, the first one is that you need to be very, very careful around the construction type of the actual unit block. Okay, is it brick or is it fibro? Is there concrete flooring or is there timber flooring? You want the former in both instances. Unit blocks deteriorate. The type of one that I'm talking about is typically, like, let's say 10 to 40, 50, 60 years old, like that, on average 30 to 40 years old. And so they deteriorate. You want to have a good quality unit block, because if something happens structurally, all 4 tenancies are impacted. Your income can dry up very quickly. If something happens, then the cost to improve, refurbish, renovate, or replace is much more, because the house or the dwelling has more to do on it than just a normal standard house, because it's bigger, right? There's 4 units in there. It is bigger, so you need to be careful of those maintenance considerations. The second thing, and I think this is really important, I hope you're with me so far, the second negative about unit blocks is that really, even though the yield is higher than a normal freestanding dwelling, you really need 8 to 10% yield, for it to really work, okay? And why do I say that? I say that because there are higher insurance and maintenance costs and rates with unit blocks. Okay, I'll get to that in a second. But those basically eat up into your gross to net yield. So if you're getting like 8%, let's say, gross yield on a unit block, and let's be honest, I post these deals all the time. Let's say you get a normal freestanding established dwelling house, like a normal one, standard orthodox, for 7% or 7.5%. It's like, why take all this additional risk? And I'll get to what risk means, of buying a unit block for just an additional 0.5 gross yield, which will be diluted anyway with additional maintenance and additional rates and additional insurance. It doesn't quite make sense. So, a lot of you are probably going to be, tuning into this episode, and you're like, well, PK, I hear your negatives and I hear all the future negatives that I'm going to go through in a second. And you're like, but I've made a killing from unit blocks. Well, that's true. Like, let's rewind to 2010, maybe even 2015, unit blocks were yielding almost 10%, 9%, above 8%. Now they don't really yield that on average. It's very uncommon to see above 8% yielding unit blocks. And back then, from an economics perspective, like I just stated, it made sense. Now, the average yield for a unit block is under 8%. So it doesn't really make sense to go for that, and with all its negatives, versus a normal freestanding established dwelling. And here's the third negative of a block of units, is that over 4 units, sometimes 4 units, but definitely over 4 units, is considered commercial lending from the bank. What does that mean? They think of it as a commercial property, not a residential property. That has different implications. A couple of them are that the loan amount that they'll give you is perhaps only 65, maybe 70%. So you need to stump up 30%, 35% deposit, which all of a sudden is a completely different ballgame to a normal residential property where you only need to stump up 20%, or if you use LMI, which I highly recommend you do, depending on your strategy, maybe you only have to stump up 12% or 10%, right? So the ability to scale a portfolio is diminished with a unit block strategy, because you're having to save and, get so much more deposit every single time versus a normal residential accumulation strategy. And let's be honest, if you want net wealth, you need to own multiple assets. The more assets that you can own, let's say they go up 10%. If that's across 5 properties, 10 properties, that's a big deal. If it's just across 1 or 2 properties, that's still good, but it's not such a big deal. So the name of the game in property investing, if you're looking for net wealth, is to own as much of a portfolio value as you can. And so lending strategy and the ability to use other people's money, the bank's money, is very important, because most of us, let's say if you're on an average income, you can't come up with a 30% deposit very quickly every year. The second implication with a commercial loan, because it is 4 units or 5 units plus, is that the interest rate will be higher. So normally commercial loans, commercial property encounter a higher interest rate, like let's say 1%. I'm just generalizing here, 1%, 1.5%, or even just 0.75%, right? That is still a higher interest rate. So it comes back to the point that I was making before. Even though yields are higher in block of units, they are not high enough disproportionately to account for higher interest rates, holding costs, maintenance, insurance rates, etc. And that's exactly the fourth negative, which I did allude to before, the insurance costs. Okay, so it's like not every insurance company will even take these on. If they will, they'll want to insure every single unit separately. So yes, it's like one big dwelling, right? They're all attached, of course, but they want to insure every unit individually. So it's like paying the same as having 4 houses, right? So it doesn't quite, so you kind of stack up from that perspective. People don't realize just how high the insurance costs are, and the same with rates. So once again, like coming back to brass tacks, where the rubber hits the road, I really wouldn't buy a block of units unless it really has a high 8 or perhaps even 9% on it. That additional interest rate that you're paying, the additional fees that you're paying, you got to account for that. And after all is said and done, if the block of units is only yielding 7 or 8%, look, net is basically the same as a freestanding property, but with all these additional downsides. The fifth downside of a block of unit strategy is that it can actually be quite hard to sell these. If you think about it, no owner occupier is driving down the road with his husband or wife or whatever the case may be, and it's like, oh honey, that looks like an amazing place, we should live there, right? No owner occupier ever really said that. So owner occupiers don't want to buy these. Therefore, the resale-ability is truncated from 100% of the market to just 30% of the market, 70% of the market being owner occupiers. So generally speaking, it's a high risk thing. When you're limiting your ability to sell a service or product to a few, that's not a good thing unless you're really sure about that strategy. So from that perspective, for the average mum and dad investor, I think it's quite high risk. And the sixth downside, look, I know in one of the positives, I was like, oh, you can make $600,000, hypothetically, by just strata titling them, by filing a bit of paperwork with the council, spending $10,000, $20,000, $30,000, and then having the ability to strata title them and increase the value of each unit from, let's say, 400 to 500 or 350 to 450, whatever it is. You're like, oh, well, that positive trumps all these other negatives that you've been talking about, PK. I get what you're saying, but this negative of having to manage then all of these properties and their common areas. Like, you are the body corporate, you are the company in charge of managing that whole dwelling, including the driveway, the gardens, like common areas. Maybe there's clotheslines, letterboxes, there's neighborhood disputes. And I don't mean with like neighbors, I mean like one tenant in a unit versus another tenant, a neighboring unit, they're right next to each other. If they don't get along, like, that's a royal headache for the landlord, for the property investor, for ourselves, as well as additional cost. And look, most people, you can outsource that to a property manager, but once again, that's additional cost. I do recommend you use property managers, but then the property management fees are higher for unit blocks. And if you do it yourself, like, it's not quite a part-time job, but it can be, depending on how disruptive the tenants are. So once again, there's additional paperwork with running a body corporate and, just managing the relationship between those tenants, and also the relationship between the tenants and each of their properties and the common area. So you got to account for all of that. So overall, I did promise I'll give you my synopsis. I've never bought a block of units for that reason. Did I see them available when I started investing? Yes. But for me, especially when I started investing back in 2011, I was much more, I wanted to be passive. I wanted this thing to be like just doing, chugging along as a side hustle. I was concentrating on my job, building that borrowing capacity so I could build a portfolio on the side that would ultimately transfer my active income to passive income. I could stop working. And for me, if I had I have 12 properties right now. If I had 12 blocks of units, like, that would be almost like a full-time job in my sort of risk appetite and just who I am. I just don't need that in my life. And I'm glad I didn't go down that way. Now, that having said, could I have made tons of money by doing strata titling and all that sort of stuff? Yep, I could have, but I decided not to, because the negatives for me and my risk appetite outweighed the positives. And right now, fast forward, 12, 13 years, the economic environment is different. The yields are almost like 3-4% less than what they were back in 2011 to 15, when blocks of units were quite attractive. So I would almost say right now it's a no-brainer. 95% of blocks of units are just really terrible for the average investor. So hopefully that brought you value, guys. And I always want you to concentrate not on external real estate, but internal real estate, the 6 inches between your 2 ears. That is what's going to allow you to exit the rat race, not anyone else promising any magic gimmick or shiny object, including me. All right, so level up for free. You can also please join the Facebook group, more than 30,000 amazing investors, Australian Property Mastery with PK. I'm so grateful each and every day for you guys, you part of my community. Kudos to you for building what we have, and I'm so happy that it's bringing you so much value. I'll see you next time. Catch you later.